Since the surprise result of the UK's EU referendum on Friday, the 24th of June, has been much talked about some of the big blue chips, some of the big companies, how they're going to suffer, where they're going to go, who they're going to start pairing off with, whether or not they can do cross-border deals. But what about the small caps? Well, we're talking now to a small cap specialist from Stockopedia.com. It is Paul Scott, who's been with us before. Paul, welcome. Welcome back.
Jeremy, thank you for having me back.
We've spoken to you before about some of these small caps, but it was a time when things were a lot more calm.
It certainly was.
It's been an interesting week for the blue chips. What about the small cap index? Just talk us very briefly through the way in which it's moved in the context of the moves that we've seen in the FTSE 100 and the FTSE 250.
Well, the Friday and the following Monday, immediately after the Brexit vote, you just had pandemonium, pretty indiscriminate selling, and then since then we've had a gradual sort of recovery. I mean, I compared the four indices I look at between the close of play immediately before the Brexit announcement and yesterday close of play, so a 1 week difference. The FTSE is actually up 2.6%, which I think has staggered everyone. But of course the core reason for that is that something like 70%-ish of FTSE 100 earnings are dollar denominated, so that's a currency effect. The mid-cap index has actually dropped about 6%, and so has the small-cap index. AIM is a little bit of an aberration, down 2.6%, because 5 out of its 6 largest constituents have had positive company news, so we can ignore that. So small caps, yeah, lagging, and mid-caps lagging well behind the FTSE 100 at the moment.
Was it an indiscriminate selling for small caps?
To begin with, yes, but I think you had particular sectors that just, where we saw a pretty remarkable derating of entire sectors in 2 days, whereas normally at the end of a bull market, that happens over an extended period of several months. So recruitment, for example, house builders, these things were massively slammed, huge moves, with the large caps and the small caps as well.
We've seen a lot of direct dealings actually this week as well, I think, in some of these big stocks, especially the house builders as well. So we're looking potentially here about stock picking, aren't we?
Yeah, absolutely. I think whenever you get a panic sell-off like this, people are rushing for liquidity, it creates lots of opportunities for people who know the stocks in more detail and knows which ones actually probably shouldn't have been sold off as much as they were.
So what's your base case in terms of some of the headlines to watch out for in the stocks that you're looking at? What exposure have they got particularly that are going to benefit those over others?
Well, I think the key thing probably at the moment is the devaluation of sterling. It's moved so much against the dollar. You've really got to find out what proportion, the geographical spread of turnover and profits for individual companies is. What we're finding is that quite a lot of even smaller caps have significant amounts of dollar earnings, and they've been sold off as well with everything else, and that's a quick rebound for maybe 10 to 20% for people who understand and know that company and know it shouldn't have been sold off. So there have been lots of opportunities like that this week.
Just a couple of things before we get onto some of the individual stocks. What about the liquidity in the small cap?
Very, very important point. I mean, liquidity is there when you don't need it. But what I found to my great cost in 2008 was that, particularly if you gear up on very small illiquid stocks, and the bigger the position, the worse it is, you can't get out of them. So that massively makes risk reward far, far worse with small caps in a crisis. So I think everybody should be terribly careful about not using gearing on these small caps, or if you do, then spreading it over a lot of them. It's gear today, gone tomorrow is the thing. Gearing itself isn't necessarily dangerous, providing you can get out of the positions. And with micro caps, I wouldn't gear on them at all in markets like this.
So is that your big mistake learning exercise from 2008?
Absolutely. I always have to learn my lessons the hard way, and in 2008 I personally lost about £5 million through being geared up on micro caps that I just couldn't get out of. The market dried up. And it was a catastrophe.
Have you made that up since? Just as
no, I've recovered to a certain extent, but I'm not taking the same big risks that I did then. I think it's better to, get through a difficult patch, and I do want to warn other people about the dangers of it really is. It's not ever a good time to take big geared positions in illiquid stocks.
Talk about warnings.
Yes.
We have had some small cap warnings this week.
Yeah, we have. Foxtons warned on profit profits on Monday. Not really a surprise, you know. I mean, the London property market, particularly the high end, was sort of freeing up well before the EU referendum. They put out a warning. The shares have dropped. I mean, it's quite interesting. A lot of stocks already anticipate a profit warning. They come down in price because everybody knows, yes, they're probably going to warn. Then they drop again, another 20 or 30% on the profit warning. So you might then start to see opportunities. I'm not sure about Foxtons yet. I might watch that one, but of course about half their business is lettings, which will carry on as normal, you know, and also anecdotally I'm hearing that foreign buyers are actually coming into the London market now because everything's 10-15% cheaper
because of the sterling devaluation.
Yeah, so it could be a blip. I don't know, but it might be. So
Brammer, another one on
Brammer warned. Yeah, this is now this one was a much more serious warning. It dropped about 57% because they put in something saying they're going to be very close to breaching their banking covenants. Now, whenever I see that in an RNS, I absolutely run for the hills because you're then into a potential situation. We saw that again with a company called Sepura recently, where they again had borrowed too much money. They ran into a patch of tough trading. The share price collapsed. Sepura dropped by 85% from the highs. Brammer was down 57% on the day. But I think it'll probably get through it, that one. Brammer might have to raise a bit of equity, but it's an possibly interesting special situation.
What is Brammer? What does it do?
It's some sort of engineering group that does sort of... it's exposed to the oil and gas market, and it's pan-European.
Because there are some engineering companies that are doing well, like Flowtech.
Yeah, well, there's interesting read across, actually. Flowtech Fluid Power... not to be confused with Flow Group, which is vastly inferior. But Flowtech Fluid Power has sold down heavily in sympathy with Brammer, but I think it's actually a much better quality, albeit much smaller business. So I think that's oversold now, so I've been buying a few Flowtech Fluid Power.
Talking there about the housing market, how about some of the things that are associated with moving and new houses and so forth? What's the...
Well, good question. I mean, they've all been sold off as well. I'm starting to look in that sector, because my belief is with interest rates now likely to stay ultra low for an extended period, you know, housing is it's still affordable, not on income multiples, but certainly on mortgage repayments. It's a lot cheaper than renting. So I'm actually quite sanguine about the housing market. So I'm looking for opportunities there. I've recently bought some Tops tiles, which I think has been dropped to about a third. Now BlackRock were buying heavily just before the referendum, so I think that'll go up. Carpetright as well put out an OK trading statement recently, and I think they've got some... I think that's got good upside from the current level, but both very bombed out, but fundamentally quite good companies.
You mentioned about the US dollar. This is going to be a really big factor, of course, not so much the dollar, it's the pound, especially against the dollar. What about those dollar earners? I think you alluded to them earlier on. In terms of some of the picks in that area, what should we be looking at there?
Well, I've got two ideas there. There's a company called Somero Enterprises, ticker SOM, which is a global company, but it's actually based in America, but listed on the UK market, and reports in sterling. So, of course, their profits have just gone up 15% roughly. Their main market that they sell to is the American market, but initially the shares dropped on the Brexit vote, so that was an obvious buy, and it has now actually risen about 10%.
But do they import raw materials at all, or do they import?
There'll be an element of that, yeah.
So there's that to consider, because that's going to be more expensive.
Yes,
of course,
yes, that's right. It may not. There may not be a complete read across from the currency, but it's certainly very favourable for them. And you've got a similar currency impact favourably for UK exporters. So on that front, I've recently been buying Port Merion, the pottery company, and Zytronic, which exports about 95% of its production made in the UK. And again, both of those dropped on the Brexit fear. They shouldn't have done, in my view, and they're starting to recover now.
You mentioned recruitment as well at the top of the interview. Yes. I mean, for the large cap aficionados, I would know the likes of Michael Page and that sort of company. What about the small cap recruitment?
Well, I mean, one of the first things companies do when they're uncertain about the outlook is they freeze new hiring. So I think that the recruitment sector is undoubtedly going to suffer over the next 6 months, if not more. But that's been reflected in the share prices. A lot of these things have already been marked down a huge amount. We've had two warnings. Prime People put out excellent results, but said we're nervous about H2. Interquest warned on profits. These are both very small recruiters, and the shares were slammed. They halved, even though it wasn't that bad a profit warning. So I think this is an interesting sector. Staffline is my current pick in that sector. It's dropped by at least a third, the shares have, but it's a really good, well-managed company. I think it should be pretty well insulated from any downturn, because it supplies blue-collar temporary workers, which isn't going to stop, is it? So.
One other sector I'm interested in that you've highlighted is car dealerships. And one particular stock there. What do you like about car dealerships?
Well, the car dealership, the models has changed considerably over the last 2 or 3 years. Instead of people buying them on credit now, what tends to happen is that something like 80% of private buyers are now actually taking personal contract hire leases, which are very, very cheap because interest rates are so low. I mean, I've got a brand new car recently and I'm paying 200 odd quid a month for it. It's ridiculous. So I don't think actually new car sales are likely to drop that much. And in any case, the dealers don't really make the margins on the new cars. They make the margins on the after sales. And so these new hire cars are generally serviced at the franchise dealer in the first 3 years, because you have to on the terms of the lease, and that's where they make their money. So my pick is called Virtue Motors, ticker VTU. The shares have halved in the last few months, but it's got a bulletproof balance sheet, it's got net cash, it's stuffed full of freeholds, and I don't think the earnings will drop that much. So I think that's an interesting one. And big director buying recently as well this week.
Yeah. Let's move ahead and take a look at the rest of the year. We're in the second half now. How do you see the second half developing? I mean, you mentioned a couple of companies there with warnings already, and I guess that was because that was already in the pipeline. Do you see what has happened recently with the downturn in our spending and all there could well be a lot of warnings?
Definitely. I think there'll be profit warnings galore in the second half. So we've really got to think through the business model of every share we invest in. And I've chucked out things where I've got any sort of doubts about them. So I think big ticket consumer items might well be deferred. I don't think this is necessarily a time to be in things like double glazing or conservatory shares. Cars is a bit different, as I say, because of the structure of the industry. And I think you just have to be prepared. You know, I think if you buy something now on a PE of 7 and the earnings half, then the PE's gone up to 14. It's not cheap after all. So I think balance sheet strength is absolutely key. Companies that have borrowed too much and suddenly their earnings collapse, they could be in big trouble with the banks. So I would avoid any highly geared companies
If anybody wants to link in more with what you're saying, how do they go about it?
Well, I write a daily article every morning for Stockopedia.com/small caps. It's free, although they do ask you to register just so they can try and persuade 1 or 2 people to become clients. And it's driven by trading updates and result statements. So I'm a former accountant, former FD, so I dissect the numbers and I look for things that are wrong in the numbers, and I've got a pretty good track record of identifying dodgy companies and warning readers about them.
And you're also an IG client?
I am, yes.
What do you like trading on the IG platform?
Well, mainly small caps, actually. I mean, it's surprising how far down it goes. But also, I think there are some quite good hedging instruments, for example. I mean, a lot of people make the mistake of shorting the FTSE 100, but that's not relevant to small caps, as we've seen recently. I think that you can use you can short the mid-caps index on IG, which I use sometimes as a hedge, because where you've got, say, a 5% spread on a small cap, you don't want to be going in and out of that. So you want to hold your position, but maybe have a short on the mid-caps index, you know, when you're nervous.
Okay, look, it's a pleasure, Paul, and thanks indeed for coming in. It is Paul Scott, as we heard there, who is an IG client, and some advice there. Also, to be able to catch up with him on Stockopedia.com on his blog. He is there from Stockopedia.com with us here on IG Live.